Hello everyone, I am Dr. Jamuna, Associate Professor of Management from Tecnia Institute of Advanced Studies. Today, we are going to see some lecture on stock invest. First, let's see the definition. A stock is a general term used to describe the ownership certificates of any company. A share, on the other hand, refers to the stock certificate of a particular company. Holding a particular company's share makes you a shareholder. So, investing in the stock or shares is known as stock invest. Stocks are of two types, common and preferred. The difference is while the holder of the former has voting rights that can be exercised in any corporate decisions, the latter does not have. However, preferred shareholders are legally entitled to receive a certain level of dividend payments before any dividends can be issued to other shareholders. There is also something called convertible preferred stock. This is basically a preferred stock with an option of converting into a fixed number of common shares, usually any time after a predetermined date. Now let's see how to choose or invest in stocks. Investing in equity has been perceived as a source of wealth maximization. However, identifying good stocks can be a difficult exercise. It is an art that one needs to develop over time. So there are certain things that has to be considered before taking investment decision. Stock picking is an art that you may require quite some time to develop. Here are a few things that need to be considered to select stocks which gives a consistent return. First one is earning per share, that is otherwise called EPS. While researching on a stock, the foremost factor to be considered is the earnings per share. It is important because it divides the net income of the firm based on the number of equity shares outstanding. In this way, one gets to know the amount of profit which the company makes on each share. Ideally, good stocks are those whose EPS has grown over a set period of time, say 5 years. On the contrary, inferior stocks are those which have a stagnant or gradually decreasing EPS. Then the second one is stable business model. Veteran equity investors understand that buying a stock is like owning a company and its business. So, whatever business risks the company is facing, the investor's portfolio will also carry the same when he buys the stocks. Thus, while studying the company's balance sheet, you need to ensure that it has a stable business model. A company having large revenue flows of, say, at least rupees 1000 crore in sales and a big customer base has a higher probability of survival in the long run. Automatically, it will have a relatively lower business risk as compared to its competitors. Then the third one is low financial risk. Financial risk occurs from a lot of debt on the balance sheet. Basically, debt is an essential component in the growth of a company. It gives a leverage to the company and helps to increase return on capital employed. However, if the company gets into too much of a debt to the extent that it becomes unmanageable, it can backfire. You may perceive it like a hole which might sink the ship if not plugged on time. While shortlisting stocks, look for companies which do not carry high debt and in turn less risky. Then the next one is focus on value adding companies. While deciding to invest in a stock, one need to ensure that the company is constantly creating value for its customers. It can be looked in such a way that it has a competitive advantage in its domain that the peers cannot achieve easily. One should look for unique selling propositions which the company has created for itself. It can be understood as a company which is able to earn more than its cost of capital. The investor may use return on equity, that is ROE, as an indicator of management's performance. Go for companies which have a ROE of at least more than 15%. Then the next thing to be considered is don't lose money. There is one thumb rule that the investor should always follow in equity investment is never lose money. It can be understood as never end up paying more than what you actually get in return. Additionally, the investor need to take steps to prevent the portfolio value from falling more than your target. You may use a ratio called dividend yield to get an answer for the above. A dividend refers to the part of profit shared by the company with its investors. If you find that the dividend paid by the company is stable and increasing, then it shows the company is experiencing a good cash flow and a positive outlook for the future. A decreasing dividend, on the other hand, means the company wants to retain some cash to meet other expenses. Look for companies with a high dividend yield. Hope you understand the topic stock invest. Thank you very much.